Hey guys, Eric here, Mr. Fired Up Wealth, and I hope you guys are doing great today. I want to talk to you today about tax loss harvesting. I'm actually going to do probably a series of different videos discussing some tax tips and techniques that I use in my taxable account. If you're following the Fired Up Wealth movement, or if you're even just following the regular FIRE movement, financial independence, retire early, you're probably going to need a taxable account in order to make that happen. And so since you have a taxable account, there are some, there's some tax rules that you need to follow. There's some tips that could help you, and there's some ramifications if you do things the wrong way. So it's important to understand how the taxes work, and those change all the time. So it's very important to keep up on that. This is for 2019, and I'm going to give you 5 tips that I use in my taxable account. The majority of my assets are in a taxable account so that I can use that account to retire early and live off dividends. So let's just jump right into it. So 5 tips for stock market tax loss harvesting. This is most useful for a taxable brokerage account, which a lot of you probably have, like a Robinhood account or a Fidelity account, TD Ameritrade, etc. IRAs are treated differently, and there's different types of IRAs. So today we're going to look at stock market tips for a taxable account. So the key takeaways really are that the investment losses really can help you reduce taxes by offsetting gains or income. And even if you don't currently have any gains, there are benefits to harvesting losses now, since they can be used to offset income or future gains. If you have more capital losses than gains, you can use up to $3,000 a year, based on 2019, again, tax rules, to offset ordinary income and carry over the rest of future years. So if you have a $6,000 loss, you can do $3,000 one year and then carry it over and do $3,000 another year. Obviously, losing money is not anyone's idea, of a long-term investment plan, but a well-diversified portfolio will almost always contain some investments that indeed have lost some money. I've got several, and at least in the short term, especially if you're actively buying, sometimes an investment loses value, and what can you do to turn it into a positive, right? Maybe not be quite as bad. You can sell stocks, bonds, mutual funds, or other investments that have lost value to reduce federal taxes on capital gains from winning investments. Or you could get a federal tax deduction. It's called tax loss harvesting. And I'll use it often. Say I want to sell something, I have a $10,000 profit. I might not have $10,000 in losses, but I might have, say, $2,000 loss on something. I can sell both of those, and now I only have an $8,000 realized gain for taxes. So it helps you reduce the amount of taxes that you're going to owe at the end of the year to Uncle Sam, which is it's a very, very good technique, and it's helped me outperform, actually, because it allows me to free up capital and then reinvest it into something that's going to perform better than what it would have been in the dog that I happen to own. People, you're going to make mistakes. Sometimes you have to cut your losses and move on. And tax loss harvesting can be a huge benefit. It's also one of the reasons why I have so many holdings, because it allows you to have maximum flexibility when it comes to this. The key to an effective tax loss harvesting strategy is to evaluate what you own and why you own it, identify investments that have lost value, and then consider the sale of some portion of these holdings to offset the realized gains, even the expected future gains or even income. And you have to be really careful when you do this, because you don't want to stray away from your target investment mix or your diversification strategy. Because evaluating and managing the tax consequences of your investment decisions can be tricky, I always recommend that you consult a tax professional. I am not a CPA. I'm also not a financial advisor. So it might be good to talk to your CPA and maybe even your financial advisor and make sure you guys are all aligned on your strategy. There are really 5 things to keep in mind when it comes to tax loss harvesting. The first really is short-term versus long-term gains and losses. And this is pretty straightforward. I think most of you probably understand, what this is all about. But there are two types of gains and losses. There's short-term and there's long-term. The short-term capital gains and losses are those realized from the sale of investments that you've owned for 1 year or less. And long-term capital gains or losses are realized after selling investments that you've held for longer than 1 year. 1 year is the key, so either less than a year or more than a year. The key difference between short and long-term gains, is the rate at which they are taxed. The short-term capital gains are taxed at your marginal tax rate or your ordinary income, which can be pretty expensive depending on the tax bracket you're in. The top marginal federal tax rate for ordinary income in 2019 is 37%. And in 2019, it applies to couples filing jointly with income above $612,350 and single taxpayers with income above $510,300. For those subject to the net investment income tax, the NIIT, that's an additional 3.8% effective. So you could pay as much as 40.8% if you're not careful on a short-term capital gain when you're in a high tax bracket. And the state and local income taxes added in, the rates can even be higher. So if you live in a state like California or Minnesota or New York, it can get very painful. So a lot of people don't know this. They just think everybody pays, the same rates, but it's, it can be somewhat complicated. So that 3.8% NIIT comes into play. The actual long-term capital gains tax rate for high income earners can be as much as 23.8%. So if you make a lot of money, you're at that 20% long-term capital gain tax rate, and then that NIIT can pop in there and make it another 3.8% higher. So you could pay up to 23.8% even on a long-term capital gain if you're in the high income tax bracket. That was part of the Medicare tax. If you remember, it was introduced as part of the Affordable Care Act, and it still exists as of now, October 2019. Now, if you're a mutual fund investor, your short and long-term gains may be in the form of mutual fund distributions. You need to keep a close eye on your fund's projected distribution dates for capital gains because harvested losses can be used to offset these gains. Short-term capital gain distributions for mutual funds are treated as ordinary income for tax purposes. Unlike short-term capital gains resulting from the sale of securities held directly, the investor cannot offset them with capital losses. This is one of the reasons why mutual funds are becoming less and less popular, especially as things like the FIRE movement and taxable brokerage accounts are more and more popular. So ETFs are treated much differently. They're treated much more like stocks, and they're a lot easier and they're more tax efficient. So ETFs are generally going to be the favorite when it comes to a taxable account. People are also going to avoid things like REITs, MLPs, oil and gas companies because of the tax ramifications for some of those securities. So jump right into it here. The second one is harvest losses to maximize tax savings. So when looking for tax loss selling candidates, consider investments that no longer fit your strategy. Maybe they have poor prospects for future growth. They can easily be replaced by other investments that fill a similar role in your portfolio, etc. To enhance your potential tax savings, you should apply as much of your capital losses as possible to short-term gains because they're usually taxed at a higher marginal rate. So when you're looking for tax losses, focusing on short-term losses provides the greatest benefit because when they're first used to offset short-term gains. You don't want to have short-term gains. You want to make those zero or even negative. And if they're negative, they can carry over then to your long-term. According to the tax code, short and long-term losses must be used first to offset gains of the same type. But if your losses of one type exceed your gains of the same type, then you simply apply the excess to the other type. For example, if you were to sell a long-term investment at a $15,000 loss, but only had $5,000 in long-term gains for the year, you could apply the remaining $10,000 excess to any short-term gains. The least effective tax loss harvesting strategy, on the other hand, would be to apply short-term capital losses to long-term capital gains. But depending on the circumstances, that may still be preferable to paying the long-term capital gains taxes. And in my case, it is, which is why I said it earlier. So Focusing on short-term losses can be particularly beneficial for high-income investors. So if you make good money, for example, if you're in the top tax bracket, the difference between short and long-term capital gains can be as high as 17 percentage points. In other words, 40.8%. And this is just federal versus 23.8%, plus any state taxes as well, which could really add up. The difference can be obviously meaningful for those lower tax brackets as well, just not as much. But for example, if you're in the 22% tax bracket, the difference between the short and long-term gains rate is about 7 percentage points, 22% versus 15%. So it can be good for, both high income, earners, investors, and even those that are in the 22% tax bracket. Keep in mind that realizing a capital loss can be effective even if you didn't realize capital gains this year, thanks to the capital loss, tax deduction, and carryover provisions that we talked about earlier. The tax codes allow you to apply up to $3,000 a year in capital losses to reduce ordinary income, which is taxed at the same rate as short-term capital gains. If you still have capital losses after applying them to the capital gains, then to your ordinary income, you can carry those over to future years. So I said that earlier. Say you have a $6,000 loss this year, you can apply $3,000 on this year's return, carry over another $3,000 to next year's return. The next one is you want to stay diversified, but be very careful of wash sales. And I learned the hard way when it came to wash sales. I didn't know what it even was, and then all of a sudden I went to file taxes in the year, and sorry, you can't use this one because you bought it back within a certain time period. So let's jump into this and explain it in case you don't know what a wash sale is. So after you've decided which investments to sell to realize losses, you'll have to determine what new investments, if any, to buy. You have to be careful. Again, wash rule. So say you want to buy back the same security you sold because you believe it has good prospects for future growth, or because maybe it would be difficult to find an investment that matches the diversification it provides for your portfolio. The wash sale rule states that your tax write-off will be disallowed if you buy the same security, a contract or option to buy the same security, or a substantially identical security within 30 days before or after the date you sold the loss-generating investment. That's a mouthful. What does that mean? Well, okay, Activision, say the story changes. If you follow Activision, they had some bumpy roads here recently. Say you've owned it for years and you're like, okay, the story's changing. I want to get out of Activision. You sell Activision, but you're like, hey, I still like the company long. I just, now it's starting to go back up. If you sell it and you buy it within 60-day period, it's 30 days before and after, basically that's going to be a wash rule. So say you sold something for a loss, at any time on either side. So if you sold it for a loss, and then you basically bought it back, you're not going to be able to use that loss to tax harvest. And that can be very, very painful, so be careful of that. One way to avoid a wash sale on an individual stock while still investing in the same industry of the stock you sold at a loss would be to consider maybe substituting it for a mutual fund, or preferably an ETF that targets the same industry. Although some of the substitutions are clearly allowable, others may come closer to IRS interpretation of what constitutes a substantially identical security. So if you're not sure, again, you should probably talk to a tax advisor before making the purchase. Just be really careful. If you're buying and selling the same security or something that's very close to it, just be aware that you could get burned on taxes if you get put into that wash rule. Your brokerage is automatically going to flag it. So if you're with like I'm with Fidelity, it'll automatically flag a wash rule, and it won't apply that loss to your taxes, which can really hurt. Say you sold something for a $5,000 loss and then you bought the same stock back, even if it was one share, you now cannot apply that $5,000 loss to any of your gains, which it really, really hurts. So be careful of that. The best thing, I think, when you're doing your year-end taxes, really every time you go through and you look at rebalancing your portfolio, consider doing some tax harvesting. That's really the best way to maximize the value of tax loss harvesting. Just incorporate it into your strategy, especially year end. That's why you see a lot of people selling off. They'll do quarterly reviews, and you'll see, sell-offs the quarter, and then at the end of the year, a lot of times you see sell-offs because people are selling. Some of the dogs will get hurt even worse in, say, December, because people will cut their losses and sell and drive those prices down even lower. So the last one, you need to select the most advantageous cost basis method. And what this really comes down to is, LIFO and FIFO. So last in, first out, first in, first out. So you need to take a look at the cost basis on your investment. The cost basis is simply the price you paid for a security plus any brokerage costs or commissions. Obviously, this has changed the game quite a bit recently. This week, all the big brokerages have gone to zero commissions, which is something I thought I'd never see in my lifetime, but here we are. Even Fidelity went to zero a couple of days ago, which is insane. But anyway, if you have acquired multiple lots, say of the same security, the same stock over time, either through, say, new purchases, say you slowly bought more as each time you got a paycheck, or maybe you had dividend reinvestments, you're doing a drip, your cost basis can be calculated as the per share average of all purchases, the average cost method, or by keeping track of the actual cost of each lot or shares, the actual cost method. For tax loss harvesting, the actual cost method has the advantage of enabling you to designate specific higher cost shares to sell, thus increasing the amount of the realized loss. So it basically has to do with which shares you sell. So in other words, you bought 100 shares 10 years ago and you bought 100 shares 3 days ago. Those are going to be different, tax ramifications depending on which ones you sell. So you need to be aware of that. And in most brokerages, like I'm with Fidelity, you can actually choose which lots to sell. They're called lots. So you can go in and you can go into one of your positions, say Cisco or whatever position is. It'll show you, say you have 1,000 shares. It'll show that you have, say 10 lots. You bought 10 different lots of 100. You can sell a partial lot, you can sell a whole lot, et cetera. A lot is just, a basket of stocks that you bought on a specific date. So anyway, guys, that's my 5 things to kind of keep in mind, my 5 tips when it comes to tax loss harvesting. I hope this was helpful. Please do drop a comment if you have questions. Some of this can be confusing. Let's take this into the comment section. Feel free to stop by the Facebook group. We've got a Fired Up Wealth Facebook group, and we can dive into some of these questions a little bit in more detail on the forum there. But if you like this video, please do subscribe. Bottom right corner, hit the subscribe button. I apologize. My voice is a little bit shaky. I've been battling a cold, which is why I haven't done a video in a couple weeks. So I apologize for that. I'm trying to get well here, and hope everything is good with you. And I've got a series of videos I'll be rolling out here in the next few days. I'm really excited about. I'll be announcing that very shortly. In the meantime, I hope you have a great rest of your day, a great weekend, and I hope to see you guys soon. Take care.